What most people call structure isn't real structure. The real edge? It's not just reading market structure, but knowing which structure matters, when to trust it, and how to align it across multiple time frames. In this video, we're breaking down true market structure, liquidity sweep, an advanced top-down analysis strategy in a way that's simple, visual, and powerful. First, we have the internal structure. These are the smaller, minor highs and lows that form inside the larger swings. They're the stepping stones price creates as it moves from one major swing point to the next. While a break of internal structure might show a short-term momentum shift or even signal a retracement, it does not confirm a true trend reversal on its own. Then we have the major structure, sometimes called the external structure. This represents the dominant swing points, the clear, higher timeframe moves that define the overall trend. For example, in an uptrend, major structure is made up of the higher highs and higher lows that stand out on the chart. In a downtrend, it's the lower lows and lower highs. And here's the key. A valid break of structure or a true change of character only happens when price violates a major swing point. Internal breaks may give clues about momentum, but major structure is what defines whether the market is continuing or reversing its trend. This distinction helps prevent getting trapped by false signals. Now that we clearly understand structure and price movement, let's break down the core strategy logic behind this entire masterclass. Our objective is straightforward. We aim to position ourselves at key reference zones during the corrective phase, so we can ride the next impulsive leg with the dominant trend. But here's where most retail traders get trapped. They take every pullback as an entry. The truth is, not every retracement is worth trading. What separates a high-probability trade from a random entry is confluence, that is, multiple factors or signals aligning in our favor to increase the probability of the trade. And one of the most powerful confluences we use is liquidity sweep. But what is liquidity? Liquidity is the fuel of the market. And liquidity sweep occurs when price intentionally moves beyond a key level where traders are expecting entries, and in doing so, it triggers stop losses and fills institutional orders before reversing direction. Why does this happen? Because major players or smart money always want to buy low and sell high, so they intentionally push price beyond obvious zones, triggering stop loss of early buyers or sellers, and also triggering breakout traders to jump in before executing their large orders in the opposite direction. So as a retail trader who can't move the market single-handedly, we stay objective always and trade in direction the dominant flow or traders. Now, there are two forms of liquidity you need to understand. External liquidity. This sits at previous major structure swing highs and lows. These levels are obvious to most traders, which is exactly why they attract liquidity hunts. 2. Internal liquidity. This lies within structure such as equal highs and lows, or inefficiencies in price like fair value gaps. Liquidity sweeps are critical because they reveal smart money intentions, and they often precede major moves. There are two main liquidity setups we focus on in this strategy. The first is the liquidity sweep, before a break of structure or change of character. This can happen externally or internally. For external liquidity, price intentionally take out a previous swing high or swing low, grabbing the stop losses sitting above or below those levels, then immediately reverse and break structure in the opposite direction. This gives us a BOS with liquidity confirmation, making it a high probability setups because after liquidity comes in the major players and other retail traders trading similar concept, so we flow with the momentum. For internal liquidity, instead of market reacting immediately to a fair value gap, price intentionally completely fills that gap. This action triggers the stop losses of retail traders who trade FVGs or imbalances and expects a reaction. Only then does price move to mitigate the next key zone, such as an order block or breaker block, and from there it reacts to break structure in line with the dominant trend. Next, flip zones. These are levels that were once support or resistance, swept by liquidity, and then respected in the opposite direction after the break, when price comes for a retest aligning with institutional order flow. Please don't forget to subscribe, like and share. It will go a long way, thank you. Even after learning about market structure, a lot of traders still fail to be profitable because they ignore higher time frame context. Retail traders often focus only on lower time frames, spotting setups like choke or liquidity sweeps, but then price reverses against them. This happens because they miss the real intention shown on higher time frames. That's why top-down analysis is essential. It prevents tunnel vision and gives true market direction. Institutional trading always starts from the top because higher time frames control lower time frames, not the other way around. In top-down analysis, we group time frames into categories, usually 3, each with a different purpose. 4. The higher time frames, typically the monthly and weekly charts. These serve as our foundation. They provide the broader market context by revealing the dominant trend and highlighting key institutional levels such as major order blocks, imbalance zones, and liquidity pools. These levels are significant because price is highly likely to respect them upon mitigation. They also act as magnets, drawing price toward them, and ultimately indicate the directional path the market is seeking to follow. The mid-time frames, such as the daily, 4-hour, or 1-hour. This is where we refine the market structure. While the higher time frames give us the overall bias, these mid-time frames help us translate that narrative into actionable trading opportunities. This is where we identify and mark precise zones of interest or points of interest, POIs, that align with the higher time frame direction. Think of it as bridging the gap. The higher time frame tells us where the market is likely headed, and the mid-time frame allows us to pinpoint the exact areas where setups are most likely to form. Lower time frames, which ranges from 1 hour to 1 minute. Executing directly from higher or mid-levels often requires wide stop losses and leaves little precision. This is where the lower time frames, ranging from the 1 hour down to the 1 minute, come into play. Here, we are not determining bias, but waiting for confirmation. Lower time frames allow us to see the internal structure unfold inside those zones, helping us separate a genuine reaction from a liquidity grab. And this is where the fractal nature of the market comes in. Structure repeats itself across all time frames, meaning the same shifts we recognize on the 4-hour can also appear on the 15-minute or the 1 minute. This fractal behavior allows us to use the lower time frame as a magnifying glass, confirming whether the market is truly respecting a higher time frame level or preparing to violate it. When using candlestick confirmations like engulfing patterns or hammer rejections, we typically refine by dropping one step lower than the zone marked. For instance, if our POI is on the 4-hour, we may confirm on the 1-hour. But when relying on structural confirmations such as a break of structure or change of character, we refine even further, usually 2 steps down. Meaning that from a 4-hour POI, we might execute confirmation on the 15-minute to capture the internal shift before price moves away. Each time frame category must align for high probability trades. And you don't have to use all time frames. Your choice depends on your style of trading. A swing trader might focus on monthly, daily, and 1 hour. A day trader might use weekly, 4-hour and 15 or 5-minute, and a scalper 4-hour, 15 minutes, and 1 minute. The core idea is always to create alignment. Start big, drill down small for a better understanding of the market's intent. Let's do a quick example for better understanding, using the concept of liquidity sweep as a confluence on GBPUSD. Starting on the weekly time frame, we identify the overall market trend to establish our bias. The market is bullish, forming higher highs and higher lows. Secondly, we highlight key zones. Zones price would react to upon mitigation, such as order blocks, fair value gaps, supply or demand, and support or resistance, which are closest to where price is currently at. Looking closely, we can see price is currently at the demand zone that led to the last break of a major structure after sweeping the liquidity from a prior swing low along the way. This detail is significant because a setup that has cleared liquidity carries a much higher probability of following through than one that hasn't. Trading is ultimately a game of probabilities, and liquidity provides extra edge. For this reason, before committing to any trade, always ensure that some form of liquidity grab has taken place. This principle applies across all time frames, but its impact is most powerful on the highest time frame of analysis. Now shifting to the mid-time frame, let's take the 4-hour as an example. At this stage, price action is still bearish, printing lower swing highs and lower swing lows. However, our higher time frame, the weekly, has already given us a bullish bias. This creates a temporary misalignment. What we need to see is for the 4-hour to stop its retracement phase, stop forming lower lows, and instead begin printing higher highs and higher lows. That structural shift is what brings the mid-time frame back into alignment with the higher time frame trend. Eventually, we do get that, with a decisive candle body closing above the last major swing high, confirming the shift. Once alignment is established, we refine by marking out the key zones that could offer entry opportunities. These include fair value gaps, order blocks, and even breaker blocks, areas where price is most likely to react and give us high probability setups. Finally, we drop down to the lower time frame for precision execution, using the structure shift method to confirm our entry. On the 15-minute chart, notice that the market is already bullish. This simplifies our job. What we now need to see is a liquidity grab if one is present, followed by mitigation of our pre-marked 4-hour point of interest, and then a bullish candlestick confirmation pattern to trigger the entry. For traders who prefer an aggressive entry, one option is placing a buy limit just below the last swing low, which acted as an inducement and sits close to our second POI, the fair value gap. The stop loss is positioned a few pips beneath the zones for protection. From there, we targeted a minimum 1:3 risk to reward for our first take profit level. That target was successfully reached. However, because this setup is aligned with the higher time frame trend, you have the option to trail your stop and capture much more of the move, effectively letting the higher time frame momentum carry your trade further. Let's move on to example 2, where we apply the flip zone strategy. On USDJPY, the market on the weekly time frame is clearly bullish, but at the moment it's undergoing a retracement. That retracement shows up as a temporary downtrend when we look at the 4-hour time frame, and this is where many day traders take advantage of shorting opportunities while price corrects lower to fill a weekly fair value gap. But here's where things get interesting. Instead of continuing lower on the 4-hour, price suddenly breaks through the last major swing high. This move traps sellers who were still expecting the downtrend to continue. Once that happens, price retraces to test the broken zone, what we call the flip zone. This is where we drop down to the 1-hour time frame to refine our entry. At this level, we look for a candlestick confirmation to serve as our trigger, giving us precision and confidence. By aligning the entry with the higher time frame's bullish context, we secure a position that not only follows the larger trend, but also offers a high probability setup with clearly defined risk. The beauty of the flip zone is that it naturally provides our invalidation point. If price closes back below that level, the setup is no longer valid, making risk management both simple and precise. Want to master the flip zone? Watch our previous videos. Trading doesn't need indicators, just structure, confluence, and confidence.